Hi all and welcome back to the Global Conflicts, Trade Policy, Supply Chain Disruptions and Skyrocketing Volatility podcast. Jokes aside, welcome back to another episode of the Energy Foresight podcast. I'm Matteo Mazzoni and today with me I have Matthew Jones and Unstead. We were going to talk about the beginning of a possible new trend that we have observed recently, the breakdown of correlation among main energy commodities. But we live in a very fast-changing world, and we are recording these the morning after Israel launched a massive offensive against Iran, targeting nuclear facilities. And the market obviously is upside down, with oil prices already jumping more than 12%. Which forces us to obviously change a bit, be flexible, and try to add a bit of context to what might happen next. But yeah, hey all guys, this is we're here for this, and welcome guys.
Thank you.
Thank you.
Matt, I would start from trying to frame what is happening at the moment. What we have seen recently was a bit of a breakdown between gas, power, and carbon, which was kind of unusual, put into the perspective of what has happened over the past 3 years. But among our predictions at the beginning of the year, there was one that you pointed out was the risk of an escalation of the conflict in the Middle East with the involvement of Iran, and this is effectively what's unfolding in front of our eyes. So there is obviously a big question around possible supply losses, but what is the impact in the near term of such an event, and do we see that as potentially as a glue that will basically keep all energy commodities correlated?
I'd say it was something that we predicted at the start of the year, or seemed fairly likely that Israel would use this opportunity to try and set back Iran's nuclear aims. I think in terms of the consequences, we have to see how it plays out. You could see a scenario in which Iran is still pretty weak. It has a fairly tepid response to this, and the market settles down quite quickly. But you could also imagine a response that is much greater, and prices are sustained for a longer period. The worst case scenario would be Iran closing the Straits of Hormuz, through which about 20% of global LNG supplies go from Qatar and the UAE, and that would be incredibly bullish for the whole of the energy complex. But I think that's a very low probability scenario at this stage. So we'll have to see how it plays out. It's certainly going to be bullish in the short term. I think there's a question about how long those prices would stay inflated for, though.
Thanks, Matt. It is obviously still very early stages in terms of trying to anticipate possible reactions and the scale, the magnitude of what might happen next. It's definitely a new point in terms of the severity of the conflict in the area. Lewis, usually carbon is very reactive to geopolitics, especially in the near term. How do you see these impacting the carbon market, and especially can you frame it also within our midterm view, which is not still reflected, or was not reflected up until yesterday, into market prices?
Yeah, so for carbon, I think the latest round of geopolitical escalation has just further supported the idea that the risk reward for EUAs right now leans very strongly to the upside. Not only is the impact for carbon, let's say, once or twice removed from actually what the impact on energy commodities would be if there was a further escalation like Matt described. But here what we're looking at is potentially carbon correlating with a wider bullish energy complex. If gas is elevated, raising fuel switching costs, this will have a knock-on impact for carbon. And This filters into a view where carbon overall is supported by the expectation of much tighter fundamentals in the next 2 years. So in 26 and 27, we expect to see a significant deficit in the market balance, and this deficit is expected to keep prices elevated. And we already expect participants to begin to price in this fundamental tightness in the second half of this year. And so towards year end, we do take a bullish view on carbon prices. The current geopolitical situation is maybe accelerating the extent to which we could see prices move to the upside.
So this is pretty interesting because, obviously we don't see carbon reflected, and this is one of the aspects that we touched upon in our webinar, Matt, just this week. We don't see carbon reflecting in power prices at the moment, which is an important element, and something I want to ask you about, Matt. And now we're seeing probably that the likelihood, as you alluded to, is that gas is going to be again in the driving seat for power prices, at least in the near term. How do you see this playing out? Is it the power market currently undervaluing a lot of these risks in the near term? Gas, obviously, it's a short-term thing, which nobody could anticipate it, but carbon is a little bit more something that we've been talking about and play somehow that they know, or at least they don't ignore.
Sure, yeah, I think it's certainly fair to say that the market is underpricing contracts for the rest of the year. Given our view on carbon that Lewis laid out, we saw that for Germany, prices could be expected to be around €8 per megawatt hour higher in our carbon scenario. As you said, there's probably more bullish risk to gas than there is bearish risk at the moment, and not just stemming from the Middle East. I think that's particularly true when you get into the winter period. Then there's the risk of low wind. So we've had 8 months in a row of below average wind speeds. There was suggestions of a return to something closer to normal in May, but I think it's plausible that you get a scenario in which wind speeds are very low for the rest of the year, which again is bullish for prices. And then you've got the real wild card of France, where reactor corrosion issues were found again this week. So it's still very early stages with that news. There's more testing that needs to happen. But you could see French prices really jump up this week. And the market's going to be very closely watching that for what happens in the coming weeks and months, because we know how bullish that can be for prices if you get major problems again happening with French nuclear reactors.
Thanks a lot, man. I think that you are effectively spot on. The a few of the elements that we were taking for granted, like obviously nuclear generation coming out of France and renewables contribution. If they change a bit the outlook, that might have potential massive impact on the market across different power markets in Europe, and obviously on prices. But Luis, and this is one for you as well, because all the factors that Matt just brilliantly highlighted, they all point towards higher emissions. So is there even more bullish case for carbon looking ahead?
I think it's first important to point out that our view on carbon and the expectation that prices will increase substantially towards year end is not dependent on these risks. If anything, some of the things that Matt's described, such as the possibility for continued low wind output, potentially French nuclear issues, just adds fuel to the fire and potentially further strengthens the bullish hypothesis for the EUA market. Taking a look at power emissions, they were up quite a lot at the start of this year. They reached as high as 16% up on 2024 levels. But our base case forecast is for those emissions to normalize against last year's levels towards the end of the year. We recently did a modeling exercise that looked at a scenario which was where we see extremely low wind output for the second half of this year, which is a bit of a worst case scenario. And to our base case, this represented around a 6% increase in emissions for the EU ETS scope. So, of course, if this does play out, then the upside to emissions could trigger additional compliance buying for the EUAs. And of course, this could create additional bullish pressure for prices towards year end.
Let's try to obviously add the other side of of the market to this discussion, and because we have, I know it might not be straightforward, but basically listed a lot of factors that they all point towards a bullish environment or higher prices. But last question for both of you: what are the bearish factors that we haven't talked about, or what that potentially, obviously, tone down some of the things that we've just discussed?
Sure. I mean, I think one to consider in the shorter term is the gas storage targets. So that should be a lowering of those targets means that it's bearish for summer, although you move some of that volume risk to the winter. So I think that's one thing to look out for in the coming months. But overwhelmingly, the main bearish driver is on the demand side, where there's a lot of data that's pointing to real headwinds for industrial demand across Europe. And we're seeing some downgrading of our own forecasts for demand already in H1. And I think there's a risk that we will have to downgrade forecasts further if the pattern that we've seen in the last couple of months in terms of demand plays out as a trend for the rest of the year.
The problem that we've seen in the Q1 data is that it's a little bit misleading on industry production. We've seen this boosted by a front loading of exports to the US as firms rush to get ahead of the tariffs. But the Q2 data that's going to be released today, and we've already seen some preliminary data from Germany that suggests energy intensive industry production in April has decreased by around 2.7% year on year. It's all pointing towards the fact that in Q2, we are going to see some negative prints on the industry production side. And this again presents a downside risk should that play out into the second half of the year. And it's difficult to argue a bullish case for industry production right now. And so this is definitely the key bearish risk to track as we move into the second half of this year.
Thanks again, both. It was super interesting, and thanks for being very flexible and adjusting the agenda, as we live in a fast-changing world, and we have to be obviously flexible. That's the beauty of our job. We have to try always to put things in perspective and try to understand the impact of new events. We don't know how this is gonna unfold, but again, if you want to know more about Energy Foresight, please visit our website or reach out directly. And to the next time.
Thanks for saying.
Yes.